Let's start with Zenith because those numbers came out today and pretty much in line with what we've seen with most of the banks. Top line has come under a bit of pressure, at least comparatively, and the bottom line continues to be better compared to the low base of the previous year where we saw huge provisions on the banking sector. But what were your initial impressions of Zenith's numbers?
And with Zenith Bank, I would say we were quite impressed with the numbers. The numbers were in line with our expectation. We had expected a decline in gross earnings. We actually expected a 21% decline while we saw a 13% decline. So I would say on the top line, it was an improvement from what we were expecting. And then in terms of the profit before tax, was more or less in line with our expectation, while PAT was slightly better than our expectation. Then looking at the numbers as well, looking at the balance sheet, we saw an improvement in loans and advances compared to where the numbers were sitting by half year. By half year, there was a decline in loans and advances, while we've already seen a 5% increase, and we expect that the bank will be able to end the year at a higher loan growth as well. And I think apart from that, also if you consider the fact that there's also been an increase in the standard lending rate as well by the CBN, would expect that to also improve the numbers. And on margins wise, we actually saw an improvement in NIM as well compared to where it was sitting by half year. By half year, it was sitting at 5%, while we expected this to be at around 6.5% now. So overall, for Zenith Bank, I would say it was quite impressive.
But how did that impact on your rating of the stock?
Currently, our rating is still a buy, but in terms of upside potential, we've seen it's lower than where it was before because the stock price has actually appreciated by about 10% from the last time we rated it. And so right now, it's presenting an upside of about 18%, which in our numbers is still close to, it's still at a buy, still a buy rating. But I won't say it's one of our preferred names. We still prefer GT Bank.
Let's talk a bit about GT Bank because those numbers came out yesterday. And obviously, I think many people continue to applaud the performance of GT, particularly on the cost side, because more so where we've seen revenues come under pressure, it's very important to watch on cost, and it seems GTB is doing that very well. But what are your impressions on those numbers, and how did that impact on your rating?
For GT, it was actually quite mixed because from the top line basis, it was below expectation. PBT basis was more in line, while on the PAT side, it was below expectation as well because the effective tax was higher. It was at 32% compared to 22%, which they normally pay historically. And I think apart from that, on cost side as well, it was slightly above expectation as well. And it shows that the company is still trying, or so far it's been trying to keep costs under control. But it's by third quarter, cost to income ratio is currently sitting at about 59%, while historically, cost-to-income ratio sits at 55%, but we still expect that it will be able to bring it down by full year to about 57%. But overall, I would still say performance was quite good. ROE is still the best in the sector. Currently, it's about annualized ROE is about 17.4% compared to its peer average of about 12%. So overall, I would still say it's still better and much better than the likes of UBA and Zenith.
Well, what's your rating? Because the guest I had yesterday was a bit more conservative concerning GTB being a buy. Even though, yes, you couldn't take anything away from the performance, he was looking at the price-to-book numbers at about 1.9 times 2009, or 2010 earnings. What's your thoughts on the rating of GTB?
Yeah, we still have a very strong rating on GT Bank. I think the major reason why we believe that GT should be trading at that multiple is the fact that it's always delivered high returns on equity. Compared to its peers, it's still way over, it's superior. Currently, it's at 17%, and our full-year forecast is at 20%, while industry average still sits at 14%, and its peer average is at 11%. So I think the market recognizes the fact that GT would always deliver superior returns, and that's why it's trading at such a premium.
All right, finally, let's take a look at UBA. That's another interesting one, where the top line obviously is probably leading the sector there. I think 136 billion gross earnings, but obviously the big issue has been on the profits and that cost-to-income ratio, which is somewhere close to 80%. What are your thoughts on UBA?
Yeah, UBA has been struggling with costs since the beginning of this year, and even though the guidance is to finish cost to income at 69%, I think it's really quite unlikely. Our forecast is at about 80%, and we feel UBA will still keep on struggling with cost for now until it completes its African expansion and start getting returns from those businesses, which we feel will start coming through from ending of next year and 2011. So I think throughout next year, we'll still see that glitch in terms of performance for UBA as well because of the huge expansion it's been.
And very quickly, is it a buy though? Or is it something that you
It's actually still a buy because it's come off significantly in terms of pricing. So it's still a buy on our rating, and it still presents an upside potential of about 23%. But I wouldn't say it's still our preferred name. We'll still prefer a First Bank. We'll still prefer GT Bank in the Tier 1 names. And in Tier 2, we still prefer Diamond Bank and Sky Bank to UBA.